Okay, so cash settlement is a situation where the company agrees that it will pay you through cash settlement. So in this time around, you are not going to what be form part of what of the company, but what it will pay you, it will give it to you, it will give you the share. But when the share vests, we will convert the share into cash and pay you. That is what we call cash settlement. So having known the background as explained, understand the car settlement is easy. All right. So with this one, we all understand what we call the grant date. So the grant date is the date that the agreement is done. So assuming like the agreement was done on 20 2026. And also we also have what we call fair value shares. Now, under the car settlement, fair value of what? Fair value of what? Of the shares is what we use to what? To weigh the shares, right? We don't use the grant date fair value. And at all times, so if the grant date started from what? From 2026. So at the end of the accounting year 2027, so you realize that you will have fair value of what? Of a share. Example, 7 series. Year 2, you see fair value of what? Of a share, 10 series. And then year 3, fair value of what? Of a share, 12 series. We use the fair value of the shares to as it were, weigh the shares. So here they can give you grant date, and then they can give you what? They will also give you what you call share appreciation. So if the share appreciation is what 5,000 shares, right? Okay. So under the cash settlement, whenever you see share appreciation, they are referring to what? They are referring to what we call cash settlement, right? But when you see share option, they are talking about what? Equity shares or share option. So you see something about share appreciation. So this is in reference to what cash settlement. Okay. And again, this one too also has features as well as what they will say fair value of that. So you see fair value at what? At grant date was 5. So, okay. And again, you also see vesting period. Vesting period should be 3 years. And then you will also so let us go with this. So you have something like this. So how do you handle something like this when you are confronted with a question? Okay, so this is what cash settlement. So how do you deal with issue like this? All right, so you see that they're giving you fair value at what I grant it to be 5, and they're giving you fair value shares at the end of each accounting year, and they're giving you share application. So how do you deal with it? So you come here, you come and do your solution. You have year 1, that the first 2027. You will pick they're giving you share appreciation to to be 5,000. All right, so let me see the number of employees. Assuming you have 200 employees. Okay, so you have it here. You're giving you share appreciation of 5,000. And then they say that the number of employees who want to benefit for this share appreciation is how many? 200 employees. And then you close the brackets, and they've also given you the fair value. So you see, watch here, they're giving you fair value at the grant. It means the day that they are going to agreement, the fair value of the share was 5 cedis. But at the end of the accounting year, so at all time when you are dealing with cash settlement, you look at the shares at the end of the accounting year, not the share value at the grant date. All the time, look at the share value at the end of the accounting year. You see, so the grant date, the fair value of the share was 5 cedi. That at the end of the accounting year, the share value is what? Is 7. So you go with what? 7. So you multiply by what? By 7 cedis. Then you what? Then you close the bracket. When you are done, because the vesting period is 3 years, then you weight it by what? 1 over what? Over 3. Now, what do we have? You have it here. 2, 3, 3, 3. Then you come to what? Year 2. So you have what? 5,000 shares appreciation, 200 workers. Look out for what the next fair value of what? Next fair value of what? Of the share is 10. So you have it on 10, you weight it. Okay. So this one you will have. Okay, so then the last year, the vesting period, 500 employees multiplied by 200 multiplied by fair value at the final year is at 12. So that gives you a 3 over 3. Okay. All right, so that also give you what? 12 million. So here, when you come here, then you come and what to find, you do your extract. So you have what? Year 1, year 2, year 3. Okay, so year 1 is how much? Here we call it what? Liability. So you've promised some people to give them money. So it becomes your liability, unlike the other one where it is equity. This one, they are not your what? They are not becoming the part owners of what? Of the company. They become what? It becomes a liability to the company because when it vests, you need to pay them cash. The reason why it becomes liability. So year 1, it will be what? It will be 2 million. Year 2, it will be what? 6 million. And year 3 is what? 12 million. Now, this one, we call it was staff cost. When you make it expenses, maybe you forgot, no problem. So here, the year 1, it will be what? It will be 2 million here. The year 2, the difference between the what? Year 1 and year 2 gives you what? Okay, so this one gives you how much? So this one gives you 4, 3. So this one too give you. Okay, so that is it about that. So this is how we account for when it comes to what we call cash settlements. Now that we've had the basis here, so let us continue our conversation with it. So now let us look at what we call intrinsic value under the cash settlement. Now, when we say intrinsic value, in general, what do we mean by intrinsic value? Actually, under the word IFRS, what does it mean? We have something that we call in the money. It means either in the money or something that we call the rights. So it is what? It is the what? It is what the holder shall gain if what? If the person exercise. So here, what this means is that, have you seen that I spoke about what we call the liability here? I told you that when it vests, the people who will qualify will receive this money because it is what a liability for the company to pay the people who will qualify at the end of the vest year. So the company will pay 12 million to these people. So when the company is paying these people, this is what in the form of what weighted shares. Now, when it is time for you to pay these people of 12 million, you pay it using what we call intrinsic what? You pay it through what? Intrinsic value. You understand? So it is the what? It is the what? Fair value of what? Of a share that you use what? To pay them. And that is what we call when we say in the money or the right, it is how much is available that when the person decides to exercise, the person will gain. So here, we pay them using what we call the intrinsic value, as I earlier indicated. And how do we even determine the what? How do we determine the what? The intrinsic value. We say intrinsic value is what? Is the fair value of share minus what we call the exercise price. So the intrinsic value is equal to what? Fair value of what? Fair value of what? Of shares minus what we call the exercise price. So let me give you an example. A company give you exercise price of 8 cedis. The fair value of the share actually, if the share value of the share actually is 14 cedis. So you see rather than the intrinsic value is how much? Is what? Intrinsic value is what? Is 14 minus 8, which is how much? Which is 6, right? That's what we call intrinsic value. You understand? So it means how much they are giving you to exercise is less than how much if they want to share they want to sell the share at the what? At the market. You understand? So this is the intrinsic value. So when it is time for them to exercise this liability, the company will pay them using the word the intrinsic value. That is all that I want to draw your attention. We pay them using what we call intrinsic value. And we have something that we call the exercise what? Rights. So the exercise right is when after the vesting period, the qualified employees has the right to exercise, or they have the right to apply for the share appreciation given them. Okay, so that is it about this. All right, so now we've understood this. Let us go directly into it. So let me give you different question, then we work on it. So there's what? Share appreciation of 200 employees. We have, okay, share appreciation is 200. We have what? Employees of 20. Now, fair value at what? At grant date, 2 cities. So you have what? Vesting period is 3 years, right? Okay. During the year 1, it was projected that 15 employees will leave the company, right? In the year 2, it was projected that 10 people shall leave the company, and on the vesting period, only 5 employees left. Your date, your fair values, and then you have what? Your intrinsic values. Okay, so here you have it. 31st December 2025, fair value is what? 2.5. 26, 3, 27, 3.5, 28, 4, 29, 5. And they said also your intrinsic values 3.5, 3.7. Okay, so these are your intrinsic values. All right, so this is the what is the question given you, and they said that, let me add also, on first January 2029, 15 employees exercise their what? Their rights. So requirements, you need to what? You need to work it out. So here, this is the question that I want us to look at. So here, you'll start with what? You know the process. So you start with what? End of the accounting year. So watch it. You have for share appreciation of 200, vesting period 3 years, employees 20, fair value at grant date is 2. So here clearly shows you that the date that they agree, they did the agreement, it was what? It was fair value of the share was what? Was 2 cedis. And they also said that during the year, it was projected that 15 employees will leave the company. In the year 2, it was projected that 10 employees shall leave the company. And in the vesting period, only 5 employees actually left. That is how, and they've given you your fair values, they give you intrinsic values, as you see it. And they said that at the vesting period, only 15 employees will exercise their rights. So here, all that you have to note is this. If the share appreciation, the grant date, let me add the grant date. So the grant date is 1st January 2025. Okay, so that is the grant date. So you have it here. So how do you go about it? Simple. So you start at the end of the accounting year 2025. What do you have? You have what? 31st December 2025. Watch it here. You will see it here. It is there. Look at the fair value. Have you seen it? Okay, so you started. How many employees were you having? You were having 20 employees. That's what they said. You're having 20 employees. And they said that they projected that 15 employees will leave the company. Have you seen the whole thing? 15 employees will leave the company. So the option is with you. So all you have to do is that you will just pick what? Your calculator. So you have what? 20 multiplied by what? 0.15. You see, it means 3 people will leave. So it depends on how you want to work it out. You can come and work it out outside the what? So maybe you can find a place and then work it out. So you have what? 20 multiplied by 15%. It will give you 3. So you come and say that 3 employees will leave. Or somebody can also decide to make it this way. 20 multiplied by, if 15 people left, you have how many people remain? 85 in percentage, what? 85% of employees will remain. So all of them will give you the same out. Then you multiply by the number of share appreciation. The share appreciation is how many? 200. Share appreciation is for 200 shares. Okay. So after that, you multiply by what? By the fair value share. When you look at the fair, what is the fair value share? They brought the grand date fair value at 2 to deceive you. They are deceiving you. All you have to pick, you pick the what? The one which is at the what? Which is fair value at the end of the account, which is 2.5. So you have a 2 cedi 50 pesos, right? When you are done, then you weight it. This thing is 3, vesting period is 3 years. So you have it here. 20 minus 3 will give you multiply by 200 share appreciation. That's what 2.5. So this one will give you 2,833. All right. Then you come to 31st December 2026. So here you have 20 employees multiply. They said 10 people, 10 employees will leave. What is it? They projected 10 employees will leave, right? Okay. Multiply by 200 share appreciation. And what is the fair value as at 2026? 3. Okay. So 3. All right. So then you weight it. Okay. What do we have? Okay. So this one will give you. All right, so you come to year 3, 2027. What do you have? So you have what? 20 multiplied by, they said that 5 actually left. So you will find 5% of what? Of 20. They said 5 actually left. You see, so 5 actually left. So 1 person left times 200 times fair value as at 2027 is how much? It's 3 cedi 50 pesos, right? All right, so that is it. Okay, so this one gives you. All right, so that is it about that. So when you are done there, you come and what? Come and then draft your extract. All right, so you have what? Here to be your what? Your liability. Here to be your what? Your staff cost. Okay, so year 1, so you have it here. Um, all right, so what do we have here? You have the year 1 will be what? Will be 8, 3, 3 here. And year 2 will be what? 7,200 minus what? Minus 2,833. That will give you 4. Okay, so here we'll give you 6,100. Okay, so this is what we have here. Now you are done. So when you are done, they says there's what somebody exercise their rights. Okay, so how many people? So all you have to do is that you will find out how many employees left. You realize that the total employees, they are what? 20. And then the actual employees who left is what? 5%, which is what? 1 employee. So you have 19 employees left with the company. And these 19 employees, there is a liability for the company to settle them. The company must settle them this money. So How do we do it? In the question, they said that, however, though we have 19 employees, to settle this money, but the following year, read it. It said that the thing has vested. So the thing will vest. You see, the vesting period is here. Well, the thing is 3 years. So the vesting period ends here. You see, it ends here. So it starts from here and then ends here. The thing is 3 years. So it will end here. And the question says that on 1st January 2019, that means the following year. No, it shouldn't be 2019. It should be 2028. So after the thing has vested after that it has vested in 2027, the following year, 1st January 2028, 15 employees exercise their rights. So the following year, 15 employees exercise their rights. Okay, so when they exercise their rights, what will happen? So here you will come here, 15 employees exercise. They are what? They are right. Right. So if it's the employees exercise their right, how many employees left? So you will have employees remain. Shall be what? Shall be 19 employees minus what? 15 employees. So you'll have how many employees not exercise their right instantly? How many? 4 employees. Okay, so that's so now you've gotten all the information that you want you need. So what next? So now you are now coming to what pay. You are now coming to what pay. So how do you pay? So you come here, the exercise right. Exercise right. So you will start with what? Your balance brought down. How much is the balance brought down you are going to pay? 13,300. You have this money to settle. This is the money that you have to settle. How much are you settling? So you come here, you say cash settlement. Right? How many employees are exercising their right? You have what? 15 employees who want to exercise their right. So the employees who want to exercise their right, when are they exercising their right? They are exercising their right when? They are exercising their right on the following year, 2028. When we look at the following year, 2028, what is the intrinsic value? 2028. You see, intrinsic value as at 2028 is how much? It's 3.5 here. It's 3.5. So that is what you are going to use to pay. So you have 3.5. You understand? So 3.5. Then you multiply by how much share are they giving them as an appreciation. So we all know that the share appreciation is 200. Then you multiply by 200 like this. All right. So this is how much we are going to pay out. We are paying out. So this is the money that they are paying out. So they've paid 15 people. So when you pay 15 people, how much do you have left? So you have what? 2,800. This is how much you have left. Now, when you get to this point, have you seen that you still have 4 people who are yet to receive their money? Have you seen it? The remaining employees, these people, they didn't take their money in what? In 2028. When you look at it, 2028, 15 people took their money. So if you didn't take your money in 2028, then that means you take your money in 2029. That is the meaning. So 15 people are taking their money. So you have how many people left? These 4 people will take their money in what? 2029. That's the meaning. So if so, you have to revalue their shares. So that's where that's what brings us to the point of what? Balance carry down. You see. So how do we value their shares? Their people left are what? They are 4 people. How much share are we giving them in appreciation? It's 200 share that we are giving to them in appreciation. And and remember, when are we doing the valuation? When are we making the payment? You see, this right that we are exercising, it is being exercised when? It is being exercised on what? On 1st January 2028. So if you pay the remaining value, you also have to what? You also have to value the remainder of what? Of the money. So at the same date, so 2028. So you have to also what? Value the remainder of what? Employees who are left shares. Okay. So you pick the 4 people, you multiply their share appreciation times the what? When you come to 2028, what is the fair value of what? Of the shares. Obviously, in 2028, the fair value of the share is what? Is 4. Obviously, in 2028, the fair value of what? Of the share is 4. The fair value of the share as at 2028, it was, it's 4, right? Then you come here, then you come and multiply this 4. So that gives you what? That gives you, so that will give you 3,200 to be the carrying amount of what? Of the share. So now that you've had this 3,200, the difference between this one, 3,200 and 2,800 will go to P&L as an expenses, 400. So that gives you what? Profit and loss. That's what. So this one will go to what? This one will go to P&L. So this is what is left as a liability that will remain in the book. So this remains as well liability that remains. Initially, the liability was what? 13,300, and you've paid 15 people. We are left with 4 people. You value their shares, and we have for 3,200. The difference between what you paid and the balance left, and then after you do the valuation, the difference will go to P&L. So here we don't do the weighting anymore. There, what is left is what we assess for what? For fair value of what? Of the asset. So that is it about share appreciation and how share appreciation is paid out. So you realize that 3,200, they will pay it in what? In 2029. So how do they pay? They will pay it using the what? Using the intrinsic value of what? Of 5. Intrinsic value of what? 3.7. 3.7. If they decided to what? Up to exercise in 2029, they will fair value it at 3.7 and pay them as such. So if they are paying them in 2029, assuming in 2029 they decided to what? Pay them. So you will come here, you have your what? Your balance BD, which is 1st January 2029. So you will have the value of what? 3,200 here. And they want to what? Do cash settlement. So how many employees? 4. Their share appreciation was what? 200. You multiply by intrinsic value, which is 3.7. So the intrinsic value is 3.7. What do you have? 2,960, right? So at the end of the year, at the end of the period, when you less it, what do you will have what? 240. So clearly, this is your liability. This is your liability, and you've made payment of what? And you've made payment of this, and this becomes your what? Your balance. How much you paid is what? Is less than your what? Your liability. So there's what? There is a gain here for you. So the difference will go to what? Will go to your what? Your profit and loss. So this is again, it will go to what? It will go to your profit and loss. This is the balance left. So it is a gain to what? To the company. You are assuming you are settling more than balance you are supposed to earn. That would have been what? A cost to the company. So this one would have been what? Expenses. But since it's a what? It's a positive figure, it will go to what? It will be credited in the P&L. So that is it about that. That is it about that. All right. So thank you very much.